Look, we've had a great year, not reflected in the share price clearly, but we expect that to continue. So good year. Safety-wise, community Indigenous stuff is really very strong for us. We've got a 37% Indigenous employment record, best on the Cape by a long, long way. Quality production was a good quarter. We crushed our oversized stockpile, hence the difference between mining and shipping there, and shipped everything except about 10,000 tonnes. We achieved our guidance, 2.04 million tonnes for the year wet, an excellent EBITDA of 8.6 million for the quarter. And obviously, once we start talking 3.5 million tonnes, once we start talking 6 million tonnes, that number just grows and grows. We've upgraded our production forecast for 2019 to 3.5 million tonnes. There's a small amount of capex to be spent to achieve that, and I'll go through that in a little bit of detail. And these operational improvements, we put in the jaw crusher. That's crushed a lot of material last year. We'll crush a couple 100,000 tonnes probably this year. We've moved away from contractor mining. We're going to do that ourselves. And we're doing the DFS on the stage 2 expansion to 6 million tonnes, 40 million cash and receivables at the end of the year, and bauxite market really is quite strong. We start with this great community relationship up on the Cape. That's us attending the Panji Festival in Bamaga. And as I said, 37% Indigenous employment there. Our partners on the Cape very supportive of us, which is great. To the numbers, production and shipping results, you can see the growth there from the first quarter, which was obviously a testing quarter with the slow start and the cyclone, a lot of wet material. And then we should start to hit our straps in the second and third quarters for us of the year, with bringing our totals to 2047 and 2037, which was our production guidance. So very well done by the team on site. Point to note, the last 2 quarters we achieved an annualised run rate of 2.5. To get to 3.5, we do a couple of things, and as I said, I do talk about that in some detail. That's just the shiploading performance for the year, again showing very strong trends. During September, October, November, the mining couldn't actually keep up with the transshipping, and that we held them back. In the last month, we started to hit our straps in the mining again, and we got to 11,700 tonnes a day. That pulls about 3 million tonnes if you can do 12,000 tonnes over our operating year, which is 250 days. So even if we didn't do anything, we'd probably do 3 million tonnes next year. 33 ships loaded. A bit on costs, and this has been sort of a debate around our game for a long time, we think leading to some of the disappointment in the share price, but we've actually hit the DFS spot on. So the DFS $24.30, our operating costs $24.20. Where the big change has been in the ocean freight. Ocean freight very much higher, probably $3 or $4 higher Australian than the DFS predicated. And we've had higher prices, so the higher prices lead to higher royalties. So the off-site costs are out of whack with the DFS, but other than that, we've achieved everything the DFS said we would achieve. So I think that's a very good result. As I said, share price I don't think reflects where we're at today. But you can see a lot of those costs are trucks and labour, electricity and so on. So you see those operating costs come down when we go to 3.5. And of course, they start to really run down when we hit the 6 million tonnes in 2021. So 2019 production upgrade, we've gone from a 17% increase, 3 to 3.5 million tonnes, doesn't sound like much. We got 75% sold. I expect that'll increase in the next couple of weeks. $7 million to spend to get to the 3.5 million tonnes, and that's on a another screening circuit, a couple of extra large barges. So we've got currently 1 7,000 tonne barge and 3 3,000 tonne barges. We're going to increase that to 3 7s and 3 3s, and that really starts to mean we can load a lot more material on the water. We're also putting in a new mooring out near the river mouth, which allows us to get an extra half a barge movement per 12 hours. So instead of 4 barge movements a day, we can do 5. And that's really magically how we get to 3.5 million tonnes. 2 extra large trailers, so 2 210-tonne trailer sets will come into the business, and that's really all we need to do to get it up to the 3.5 million tonnes. So in summary, we started off with 2, achieved our guidance. We're already increasing our throughput next year to 3.5 from 3. That punches about $25 million into revenue, probably $16 or $17 million EBITDA just from that one small change. So the stage 2 expansion really is where we start to hit our straps. Stage 2, we're doing the BFS, refreshing the BFS this quarter, and that needs to go to the board for approval. Capital, when we did it last time, was about $30 million. The 6.8 we've spent on this small upgrade was part of that expansion, so we don't expect that to grow. The main change would be out on the water, where we need to install a floating crane to load bigger vessels. Once we can load bigger vessels, we can start cranking the tons. We can also take advantage of lower freight rates, ocean freight, for, say a mini Cape versus an Ultramax that we're loading today is probably $3 or $4 US. So we'll save a lot of money. As everyone knows, when the new sulfur regs come in towards the end of the year, our ocean freight will go up like everybody else's, but we're very competitively placed from an ocean freight point of view, just due to where we are in the world. Our main competitor is Guinea. So if ours goes up $1 there, ocean freight's probably go up a couple of dollars or $4. So look, we're very well placed. You can see stage 1, stage 2 there. You can see a long line mine life, 17 years. We're still sticking by our DFS numbers, which showed total costs of about 35 Aussie delivered to China. So when you start to see the bauxite price, you'll see this thing starts to generate some serious cash when we get up through the tons. Talking about exploration, we really focused on the mine area today. You can see those 2 areas. We've really drilled out quite strongly as part of our mine plan, and that the focus of that really is to try and increase the comfort in the resource, so moving from indicated to measured, and I think we'll increase the resource slightly and probably also increase the reserve slightly, but it won't be major tons, but certainly adds to the confidence of the project, and 17 years mine life is pretty healthy. So the market outlook, you can see this is a pretty stunted it sort of exaggerates this axis, but you can see that trend, an upward trend over the last 12 months or 6 months, very, very strong upward trend. This thing is fairly solid between 46 and 54 over the last 2 or 3 years, the CBIX, and CBIX is a value in use dry metric ton index. But you can see we're tickling around the $52, $53 mark, have been for a while, and that's an upward trend. I don't think it gets exciting for bauxite. Bauxite's not one of these products that goes boom, but certainly anything above $50, we're very, very comfortable. And we're seeing extremely large demand from China. We're talking to a lot of inland refiners. And for those of you who don't really understand the China market too much, there's 5 or 6 refiners in Shandong province, which is traditionally where all the exported bauxite's gone to. We're now moving into those inland refiners, and there's 60 or 70 different refineries in those inland refineries. So many more customers, opens up the world to us, and we're starting to attract a lot of interest. We've sold some bauxite into those parts of the world. So it's a very strong story. It's a cash flow analysis for the quarter. So we had about 38 million at the start. We punched 8.6 million EBITDA in. Good. I'm glad we got value. That's that's excellent. Corporate exploration, small amount of money. Capital about 2.8 million. Financing lease costs about 2 million. Little bit of working cap movement and closing cash at the end of the year. 40 million bucks. We've renegotiated the Sprott debt. The debt started to be amortized in January, the original deal. We've now moved that out to July. That just gives us a bit more liquidity during this first quarter when we have no revenue, and also just better aligns us with where we are in the world. So very good of Sprott to renegotiate that with us. Share price, pretty sad. I loved it when it was up here and we had this nice growth, but this is the real world. Sitting around 15 cents, have been for a while, gives us market cap about 200 million. As I said, I don't think we're doing too much wrong, so I think the market starts to realise we start generating more cash, etc., then that starts to grow. In 2018, we're looking at 2018 like most mines that have started up in this year. We probably performed better than all of them. Got our guidance, no great hiccups, had some weather disruptions, which you would expect up in the north. Safety, very strong customer base. We've upgraded our production for this year based on that demand. We believe we're going to have a very good year. We're going to move to owner-operator to try and increase or lower operating costs, increase margins. Very strong balance sheet, and we're looking very hard at that expansion to 6 million tonnes.